This video goes through the solution for Tess, who works at Q Corporation. Now, if you've had a chance to work through the question, you can scroll directly to the solution. If not, this is the question that is being asked. Tess is employed with Q Corp, a Canadian public corporation. And then we're given some information about the stock option she was offered last year. And then in the third paragraph, we're given the information for the year 2020. Now, if you haven't yet worked through the question, pause the video now, read this question, and then figure out the solution before moving on. Now, there's a little bit more to the question. I'm just going to scroll up now. We scroll up, we're given the rest of the question here, and then we're given the requirements. Now, looking at the requirements, the first thing you're asked to do is calculate net income for tax purposes, then taxable income, federal income tax before tax credits, and then the minimum federal income tax after tax credits, and also indicating any loss carryovers that Tess would have. So pause the video, complete the question. I'll move it back up to the top here, and then resume the video to compare your answer to the solution. Okay, we're going to move forward to the solution for this individual, Tess, and her 2020 federal income tax. So the first thing that we were asked is to calculate her net income for tax purposes. Now remember, net income for tax purposes, we go through the formula 3A plus 3B minus 3C minus 3D. Now, looking at the top here, we have her 3A amount, which is her net employment income, interest income, which equals $86,000. Now, for her net employment income, we include her gross salary and then the taxable benefit related to the stock options. So if we look at the top line here, she exercised 1,000 shares of the stock option. The fair market value was 19, but she paid 15. So she has an employment income inclusion of $4,000, and that's how we get the $84,000 for her net employment income. Now, moving on to 3B, that's where we have her taxable capital gains over her allowable capital losses. Now, in the question, we were given $5,000 as her capital loss. 50% is our allowable capital loss, which is $2,500. But because we cannot have a negative number in 3B, her 3B amount becomes 0. And the $2,500 becomes a net capital loss carryover. And that can be used against taxable capital gains, either carry back 3 years or carry forward indefinitely. Now, the one part of the question which some students quite often forget is that in the year 2020, the maximum CPP that an employer can withhold is $2,898. However, the base amount for the tax credit is only $2,732. So in the textbook, it says that this amount of the 166, the extra amount, is deductible when determining the taxpayer's net income for tax purposes. So we get to subtract the 166, and that's going to give us net income for tax purposes of $85,834, not $86,000. So net income for tax purposes, $8,834, the third line from the bottom here. Now, the next step is to calculate her taxable income. Now, when calculating taxable income, that's where we can deduct the 50% stock option deduction if it is available to Tess. Now, because the option, when it was granted last year, was not in the money, she qualifies for that 50% stock option deduction. Remember, she had to include $4,000, so she gets a $2,000 deduction here. And so Tess's taxable income is $83,834. Now, after we calculate taxable income, we're now asked to calculate her federal income tax before tax credits. And I'll just scroll up here. So right in the middle of your screen, we have the calculation for her federal income tax before tax credits, and that's $14,516, just using the information in the rates table. Then we move to her non-refundable tax credits. Well, everyone gets the basic. That's the first amount, $13,229. Now, she qualifies for the spousal, and this is important. She qualifies for the spousal even though the amount is 0, because her spouse makes net income for tax purposes of $15,000. You cannot have a negative amount, so the spousal amount is 0, but she does qualify for it. Now, when it comes to her dad, Alex, she cannot claim the eligible dependent, because if you are married or in a common law partnership, you cannot claim the eligible dependent. You qualify for the spousal even if the amount is zero. So the eligible dependent is not available to test. However, because her dad has an infirmity, she can claim the Canada Caregiver for infant dependents over 17. Now, that amount is reduced by the dependent's net income that is over $17,085. And because Alex has net income of $19,000, we have to reduce the base amount, the $7,276, by the extra income over the $17,085. So for Tess, the Canada Caregiver for infant dependents over 17 tax credit is going to be $5,361. And then after that, we have her employment tax credits, the EI, the CPP. Remember, the maximum CPP tax credit is $2,732. And then the Canada employment amount of $1,045. Then we move to medical expenses. Now remember, for medical expenses, let me just scroll up. There's that formula, A times B minus C in brackets plus D. So B minus C plus D, that's all multiplied by 15%, which is the A amount. Now, when we look at B minus C, that is for the individual, the spouse, and any children that are under 18. So in this example, we have to separate the medical expenses for Tess and her husband and separate that from her father, Alex. The father, Alex, will be the D calculation, which is E minus F. So B is the medical expenses for Tess and her husband, which is $3,200, right down here, minus C. And then C, if you remember from the rates table, that's the lesser of 3% of her net income, or $2,397. Now, once again, the $2,397 is the figure for 2020. It changes every year. So we work through that calculation. The B minus C is 803. Now we have to calculate the D amount, which is E minus F. And E is the medical expenses for the dependent, which in this case would be Alex, her father. The father's medical expenses that Tess paid for is $3,000. And then we minus F, which is the lesser of 3% of the dependent's net income. So this would be Alex's net income, which is $19,000. Lesser of 3% of that, or $2,397. Now the lesser amount is the 3% of $19,000, which is $570. And so the D amount is going to be $2,430. We add that together, so the total medical expense tax credit, the base amount is $3,233. Now we just add up the base amounts and we get $26,656 times the 15%. And so that's going to result in a reduction to her federal income tax of $3,998. Now we also have donations. And now remember, for either charitable donations or political donations, we need to have a separate calculation. So let's go down to that. Now for the charitable donations, the first 200 is always at 15%. And then remember, we said that that middle amount, the B amount, the 33% amount, that only comes into play when the individual's taxable income is greater than $214,368. Now that is not the case, so we can go directly to 29% times C. And so that would just be basically whatever's left over. The total donations was 800, so the amount that's left over is 600 times the 29%. And we work through that calculation, and the charitable donation tax credit that will result in the reduction to her tax payable is $204. So once again, we scroll back up to the top here. The federal income tax before tax credits, $14,516. We minus the tax credits. And once again, the total tax credits, if we add that all together, the $3,998 and the $204, the total tax credits will be $4,202. We subtract that from the $14,516, and we get federal income tax payable after tax credits of $10,314. Now remember that there is provincial amounts as well, but we just focus on the federal amounts in this course because the provincial amounts and provincial tax credit rates vary from province to province. So that brings us to the end of this video solution. Good luck with your studies, and we'll see you in the next video tutorial.